Shankar Sharma joining us on the phone line. Shankar, the ratings outlook on India has been revised to negative. What would you make of it?
No, I have never paid any attention to what the rating agencies say. I mean, I've been in the business for 22 years and never have I seen them actually be right on any of this. So, I don't think we should pay any attention beyond the next 5 or 10 minutes to it. I don't think the markets will react too badly either. They will bounce back once this initial sort of one-time shock is over.
Yeah, but Shankar, the markets are reacting at present. So do you believe that there was no case to downgrade India? To change the outlook?
Not at all. I mean, if we were triple B with a stable outlook going to negative, I don't see what is the big negative that suddenly has emerged. You can always say that because of the GAR provisions or Vodafone or that we had a bad last quarter in terms of FX flows. I mean, all that doesn't really necessarily mean that India will go bust or that it deserves to be actually even triple B, considering the ratings that most European countries enjoy even now, despite their being actually bust. So, let's face it, we have had a challenging period last 4 or 5 years, but almost every country in the world has had it. Within that context, I think India has weathered the Great Recession the best of almost any major economy, for sure, without any doubt. We've grown 7.5%. We have reduced debt to GDP. We have reduced interest payments to budgetary receipts. Forex flows have been by and large good, except for the blips that you keep seeing. That's fine, and we'll continue seeing that in the future as well. People focus too much on the fiscal deficit. I focus on debt to GDP, and that is actually the real number that makes countries go bust. There we have actually, really beaten almost any other major economy, including China, by reducing it sharply over the last 4 or 5 years. In fact, over the last 8 years, and that's not because of inflation, by the way. Inflation, WPI has averaged only 6.5%. So I think India's macro fundamentals really stand out relative to its peer group as well as relative to the developed markets. S&P can keep saying what it wants to say. That's okay. We should, just kind of nod and move on.
Shankar, just getting in a question for me as well. I mean, there's a knee-jerk reaction clearly, and we have seen equity markets, currency, all of that decline slightly into the markets. But do you think it makes a serious case? Because a few days back, Macquarie also exited their positions in India, and now this coming in, would you see foreign funds, because we do depend a lot on the inflows, do you think that would take a bit of a dent?
Look, now the problem that you're talking about is a completely different thing. Foreign flows, India is dependent on that. We are very clear about. Everybody knows that. GAR provisions do hurt them in the short run. That said, I think India's stock market performance will sort of beat the BRIC pack handsomely this year. We put out a report yesterday on that. Once you have stock market outperformance coming, and then people find a way to come into those markets, even if they have to pay tax, or they have to come from Singapore, or they have to come from Africa, or wherever else they want to come from. People chase momentum. I think India has got very strong underlying momentum relative to the rest of the world. If you look at out of the 200 stocks we track in India, 95 stocks are up between 35 and 110% in the last 3 months. That's an astounding performance. People keep, beating the drum on fiscal deficit and inflation, stuff like that. The fact is that the rupee was 52 in December, 52 now. But stocks, and I'm talking Tata Motors, I'm talking Jaiprakash, and I'm talking stocks you can fill a $2 billion portfolio with. They are up between 40 and 50, 100%. And that's like, barring the US, I don't know of too many other markets which kind of have given you that kind of performance, even in what has been the last 3-4 months, a very challenging period. So I think people will find a way to come back to the markets, irrespective of GAR. But yes, we could have done without it. I think it's an indefensible step, both Vodafone and GAR. But 6 months down the road, people would have worked around it and would have moved on.
You did mention a short while earlier that we should just nod and move on after this outlook revision. You also, in the same breath, mentioned that we are to a large extent dependent on foreign investor inflows. Now, wouldn't you agree that the majority of foreign investors into the Indian equity markets are in large part guided by the ratings that many of these rating agencies assign to us, and that in turn could upset flows, which in turn will upset the equity markets?
No, not at all. No investor that I have spoken to, again, like in my 2 decades in this market, look at credit ratings of a country and decides on equity market strategy. And if they do, then, I don't think they have any business being in this business. They would have been piling onto the most terrible stocks, most terrible countries at the peak of their rating cycles, and, getting out of stocks in a country which has been downgraded. So these guys have no credibility. I mean, S&P, Moody's, they have no credibility, including back in the U.S. when they downgraded. We know what happened to the U.S. bond markets after the S&P downgrade. So we should not take it too seriously. U.S. has done very well post their downgrade. Stock markets have been an absolute tear. And I'm inclined to go with the general view that our research team has expressed in our PCS today, that India will do phenomenally well as an equity market this year. I think almost everything that we watch looks very, very optimistic for India, including our bearish view on oil, our bearish view on commodities. Both those things put together, and of course the phase implementation, the UID is really bringing down at the margin the subsidy payments. This is a small drop in the ocean, but I know at the street level it is causing things to move in the right direction. Just in Maharashtra, just one simple pilot project implemented with UID is saving 500 crores. Over the next year's time, when they go to 60, 65 crores or even 50 crore Indians being covered by that, I think that will be the other thing which you will see. Subsidies will come down. Growth will be 7.5%, even 7.8% this year. Oil prices will be down. Gold prices may not rally much, which means that we won't import as much gold as we did last year, which means, less pressure on the currency. The current account deficit ex gold may well be flat to moderately negative. So I can make a case for the rupee to be 45, oil to be 75, general commodities to be down a lot on account of China's hard landing. And I know my good friend Adrian has said that they're already in a hard landing, and I tend to agree with that. So given all that, a bearish outlook on commodities, rest everything being equal, means very good things for India on the subsidy front, on the trade front. So I mean, I think, and by the way, the underlying momentum is also showing it. India is outperforming. I mean, Indian mid caps are outperforming global emerging markets indices. And I'm a big believer in relative strength. I'm seeing that seeping in already. So, my view is this thing will be forgotten, this whole rating. And you can see the market bouncing back already. The US didn't take it seriously. We shouldn't take it seriously either.
Do you think that 5.3% growth of GDP projected by them is rather pessimistic?
I think it's absurd. It's not even pessimistic. I think it's just plain absurd. Anybody who's looking at the numbers around here, cement sales are growing 7-8%. I mean, that tells me that there's a huge amount of, demand out there. If you look at the conversion of houses that were not pakka houses, as in constructed houses, to constructed houses, that data is staggering. Auto sales are looking very, very strong. Consumption overall, go and talk to companies selling in the rural markets. The land that I own in my village, which was worth like $10,000 20 years back, is now suddenly worth $4 million. I mean, I'm a rich man overnight. That didn't happen because, some miracle. There is a lot of money out there. It's being consumed. It's being invested. India's imported close to $130 billion of gold in the last maybe 3 years. I mean, that's the kind of bailout packages country desires these days. I mean, so there's a huge amount of money out there. That's being consumed. That's being invested. That doesn't lead to 5.3%. And India's sort of, if you look at the share of GDP coming from consumption, that is where China wants to go. India's already there and it's improving that. So, it's a strange situation that China wants to become India and India wants to become China, and I hope they don't, that they want to increase gross fixed capital formation. India is doing just fine. It is moderate on capex. It's very strong in consumption. Debt is reducing. Interest costs are reducing. And this S&P thing, I don't think will markedly in the outlook on interest costs. It will hurt the companies trying to raise cash, as Adrian said. That's fine. There might be some casualties. But by and large, I'm very optimistic that by year end, this economy is going to be growing at 8%. For the full year, you won't get that number. You will get it at probably mid sevens. But on a run rate basis, you may well be at 8% by Q4 of this calendar year or, Q1 of the next calendar. And the markets will begin to discount that, probably 6 months in advance. And looking at the situation oil is in, despite everything, it doesn't look to have momentum. My take is that it's already at break point. All those things put together, I mean, ultimately you have to take a call, we could be wrong, oil could be 200 and India goes down, 50%. That's fine. We've dealt with those situations in the past. Our call is India looks strong because a lot of other factors internationally look weak, which are good for India. And intrinsically, the consumption story is very, very strong. And I say this, going out there, seeing small cities, seeing companies doing business with them. things look very, very robust at the ground level. So 5.3% is an absurd number.